Hi, everyone. I'm Caroline Zakarian, and I work in the Office of Civics and Community Services here at the Los Angeles Public Library. Welcome to Financial Literacy Month. Today's presentation is called Your Savings and is brought to you by the Los Angeles Alliance for Economic Inclusion and the Los Angeles Public Library. Today, Linda Maldonado and Lisa Hill from AEI will be talking to you about how to save money for goals and unexpected expenses. They will also talk about proven saving strategies and tips on the best ways to save. We will have a brief Q&A after the presentation, so please send us your questions throughout the program. Take it away, Linda.
Hi, thank you so much, Caroline, and thank you to the Los Angeles Public Library for this opportunity to host this Money Smart series on your savings. Next. Before we begin, I want to cover a disclaimer that we want to share with you. This presentation represents the views of the speaker and not necessarily those of the agencies they represent. This presentation cannot be reproduced or distributed by a third party or on a third party website without prior authorization. And reference to any specific organization does not constitute an endorsement, a recommendation, or a favoring by the FDIC or the United States government. So let's get started. For all of you who are joining us for the first time, please grab your pen, your papers, put your thinking caps on. I'm going to be sharing some tips, some personal insights that I have learned in my savings journey. And certainly Lisa Hill will follow up with her experiences and her know-how. So today's objectives include, we're going to understand what saving is and why it is so important. Second, we're going to identify reasons to save and ways to build savings over time. We're going to learn some tips for opening and using a bank account safely. We're going to create a simple plan to save toward personal financial goals. And then finally, we're going to make that pledge to save with LA Saves. Next. So your savings. Let's get to the next slide. What is saving? We're going to discuss in this section right here what it means to save, the reason why saving money is so important, and ways to find money to save. And by the end of this section, you will be energized about saving money. Next. The key takeaway for this particular section is that setting aside some money every time you get an income is a great way of regularly saving money. Setting aside, even if it's a small amount, can make a big difference over time. That's the key. Setting aside some money every time you get an income. Regularly saving money, even if it's a small amount. Personally, I loved looking forward to my birthday because it was the one time of the year that my grandmother would send that $5 bill in the birthday card. And it was the one time that I could graduate from eating cup of noodles to perhaps maybe a hamburger at the local McDonald's back in the day when a hamburger was less than $1. But the blessing was that I was able to put $1 or $2 aside and leave it somewhere untouched until I absolutely positively needed it. Next. So when we define what saving means, savings means, for the most part, setting aside a portion of any money you earn or receive. That includes the income from a job, a gift, or a tax refund. And it's April. We've just gotten over the tax refund season, the tax preparation season. We are now expecting a refund. Statistically, for most Americans, the tax season, the tax refund is one of the largest dollars or gifts of money that we will receive. And for the most part, most Americans have already spent it before it arrives in our mailboxes or hits our direct deposit. But there has to be an element of thinking a mindset that says, I'm going to take this piece of money that I've received, and I'm now going to set aside a portion of it for an emergency or for a savings goal that I wish to achieve. And if we continue with this mindset of saving something aside that we do not touch and that we allow to grow on its own, we can then begin a mindset of saying, yes, I don't rely on this money because that is for those occasions where I don't need it for a rent. I'm not using it to pay for a need or a want, a dinner or some concert tickets. But instead, this is for a rainy day, for an emergency. And sometimes we ask the question, is spending less money the same as saving money? Is spending less money the same as saving money? And here's the answer: no. The goal is, if you are saving money, that you are going to put what you save, that saving money on that particular item, you're putting it aside again for a rainy day, for an emergency. Next. So is spending less money the same as saving money? Well, yeah, only if you save what you didn't spend. Saving is setting aside money today for the future. To build savings, spend less money and put some or all of what you didn't spend into savings. For example, if you buy a coat marked down from $200 to $100, it seems like you saved $100. But if you put that $100 away into a savings account or into your piggy bank, right? And you don't touch that $100, then that's a good thing. But if you see that coat marked down from 2 to 100 and you're going to use all of that $200 that you had set aside to buy a coat, well, then you haven't saved any money. You've actually bought the coat and then some with $200. So you want to be able to set aside. It's a mindset. It's the discipline of putting aside money to a separate account or to a separate, like I said, a piggy bank or a jar, and using it for the time when you actually need it. Next. So let's ask ourselves, why do you want to save money? Maybe there's a goal you'd like to achieve. I know personally, when I started to begin the idea of what savings looks like, my goal was I literally challenged myself to save $1,000 by the end of the year. And in the beginning, it seemed like a very lofty goal, something I probably couldn't achieve. But I had to set my mind on, how much will I need to save? How much do I drop into that 5-gallon water jug so that I can achieve that $1,000 goal? I also save money to build wealth. It is statistically much, much healthier for you to be able to make your purchases using cash than it is for credit. Even though credit is a good, healthy means of making those transactions, the truth of the matter is we are, for the most part, subsidizing our cash transactions using credit. And we are not relying on dollars, saving for something that we possibly can use to make those types of transactions and purchases. You've heard me use the word emergencies. I can't tell you how many times as a commuter in my hometown, a tire will blow out, or perhaps a nail hits it. And I will need cash to patch that tire, or maybe to replace the tire. And it feels so good and so gratifying to know that I can pull $20 or $30 out of my savings bin to pay for patching up a tire than putting $40 onto my credit card. And so please understand that the use of a savings account really does help tackle those emergencies. Savings also steps in when you have less income than you and more expenses. I was so grateful during the COVID season when I did not have the use of an income coming in, and I had savings set aside for that time. That savings helped me pay for groceries, put fuel in my car, and even treat myself to a manicure pedicure when I needed it, right? So definitely savings is a best practice for me, and certainly has bailed me out on many occasions. Savings gives me peace of mind. Savings gets and keeps the job. And there's tons of other reasons why you're having a savings account. And you look at it, think about it. Is it a vacation that you wish to take? Perhaps a class that you'd like to save up for and pay and be able to pay cash for it without having to take out a loan or use your credit card. Think about what those reasons are. Write it down. Set it up in front of your mirror, on your refrigerator, or wherever you're going to see it, and watch your savings grow. Next slide. So again, the key takeaway here is the definition of savings, the purpose of savings is always to set aside some money every time you get income. Again, income is any gift, any monetary gift you receive, any income from a job or a second job, or any type of subsidy, anything you receive, like a tax refund. And get into the mindset of regularly saving a portion of that money, even if it's a small amount, and put it aside in some location or some account that you will not have immediate access to. And over time, it will make a huge difference what you have collected in your savings journey. Next. So where do you build your savings? In this section, we're going to discuss options for where you can build your savings. Next. The key takeaway in this particular section of our discussion is to consider the advantages and disadvantages of all the savings options you have before you start choosing where to build your savings. Considering the advantage and the disadvantages of saving options. Believe it or not, many of our ancestors, we all chose to save using our coffee can buckets or in the pillowcases. And there were advantages and disadvantages to that option. We're going to talk about that in this section next. So where do you put your savings? For each savings option, there is an advantage and a disadvantage. Next. So if you decide to save your money in that pillowcase or in that 5-gallon empty water jug that I believe every home in America possesses at some point, the advantage is there's no fees, no rules, there's no cost to maintaining it. It's convenient and it's easy to access. It's right there. It's in your home. No one is touching it except to put something in it. There's no cost to having that kind of savings option in your home. But there are some disadvantages. It can be lost or stolen. Yes, it can. It can be destroyed in a fire, a flood, or a disaster. And guess what? Just as easily as it is available to you to add dollars into that in-home account or place in your house, it also is easily accessible for when you want to take it out, when you want to dip into it and use it. Okay, next. So we've used the savings account option because for the most part, we believe in a couple of things to be true when using a savings account to save our money. Every account, whether you choose to use your or place your savings in a bank secured account or in a credit union, every single deposit is federally insured by the financial institution up to $250,000. So it's secured. You are able also, which is one of my favorite options, to directly deposit a portion of my income into a savings account that I do not easily desire to have access to. Whether you decide to put a portion of your income into a 401k or a high yield savings account, or even into a credit union account, it is an account that is separate and distinct from the place that I choose to have my checking account. It is specifically designated for my savings. I am also able to automatically move money from checking to savings. I have on many occasions, when I've received a deposit of some kind, a Zelle payment, I have often chosen to move that Zelle payment or whatever monetary gift I receive in my checking account and move it into my savings. Also, depending on what type of savings account you have, it may earn interest. Sadly, many of our commercial and community banks are not offering huge interest rates in our savings and checking accounts. However, there are specific savings accounts, high yield savings accounts, HYSAs, that can offer up to 4.5% interest on your dollars. And it makes a difference because those interest costs will compound daily, quarterly, monthly, yearly, and it will add dollars to your account and help you to reach your savings goals a lot faster. Easy to access. Yes, if you do need to access your dollars via a savings account at a banking institution, absolutely. The use of your ATM card or going into a building to actually receive your money is available to you. And then most importantly, you want to establish a banking relationship with your neighborhood banker. Believe it or not, there are actual staff in your branches that are interested in helping you meet your financial goals. In some banking scenarios, they are wealth managers or perhaps financial managers. But the whole entire premise of their business is to help you to establish a banking relationship with them that will help you meet your goals. Now, there's some disadvantages to this, to having a banking account. There are monthly and recurring fees that can vary. They are not always the best option for saving money for long-term goals because the interest you earn may be lower in certain places. Financial institutions may not be available or may not have access to online banking or your ability to access that money when you need it. I'm thinking of COVID. That was a huge period of time for many of us where banks were shut down and ATMs were not functioning and working at that point because, of course, staffing was needed. The technological components that helped to keep that ATM functioning were under attack during that season. And so you want to be sure to be available to the pros and cons of every situation. And then finally, having an account, depending on the type of account you have with your banking institution, may have limited numbers of withdrawals and access to that money. Next, again, deposits in a federally insured financial institution are insured to at least $250,000. And that applies not only to your banks, but also to your credit unions. Next. So these are some other options that you can use to save your money. For example, money market deposit accounts, otherwise referred to as MMAs. These are often available in banking institutions, and it's a account that generally offers a higher rate of interest than you would earn with a savings account. Okay, you will probably have to have a higher minimum balance in that account, but you will definitely have limited options to accessing that money when you need it. But money market accounts are surely a great savings option if that works for you. Another one of a savings option is called a certificate of deposit, or otherwise a CD. And I remember my first experience with a CD is I came into an inheritance of some sort, and my father took that money and purchased a CD, a certificate of deposit. And that amount of money was placed in that CD at a fixed rate for a period of time. In this case, we renewed that CD up until I was 18 years old. So I believe he renewed it a couple of times from the time that I received it to the time that I turned 18 and was able to access that money. And what that CD did, it was that the interest rate in which the CD was purchased was fixed and established for those 10, 15 years. And it had compounded where the original amount of money that was used to purchase the CD had almost doubled and almost tripled actually in value. So you want to consider and may consider that as an option for saving money. You may want to consider a U.S. savings bond. You can purchase a savings bond for as little as $25 through www.treasurydirect.gov. This is an individual savings bond that you hold for at least 1 year before cashing it. And if you cash a bond in the first 5 years of owning it, you will lose about 3 months of interest. But the bottom line is contributing to or purchasing a savings bond is that it is protected and bonded by the U.S. Treasury, and it allows you to, again, compound interest over time. I know a lot of grandparents that decide to buy their firstborn or their grandchildren that savings bond, and they hold on to that savings bond for literally the entire life of their child until they're getting ready to go to college or open a business. And it's such a cute, romantic way of starting to save money for their child, for their grandchild. There's also retirement accounts, individual retirement accounts like IRAs or Roth IRAs. Remember, keep in mind that all of these individual retirement accounts are yours. You open up an account using a brokerage firm, Fidelity, Vanguard, maybe another opportunity, and it is your account. You can add as little or as much as you'd like to add to that savings account. If your contributions are tax deductible, if you choose a Roth IRA, those deposits are taxed in the beginning, and you then receive whatever revenue you want to take out later on tax-free. Okay, so you want to make sure that any Roth IRA or regular IRA has parameters that you can live by, that you read carefully so you know how it can best serve you in your retirement age. And then finally, investments such as stocks and corporate bonds and mutual funds are also available to you. A great website to read through to get more information on all of these types of savings options are www.investor.gov. Next. So you heard me mention words like interest and compounding. Interest, the simple definition, is money that financial institutions pay you for keeping money deposited with them. and it's usually expressed as a percentage. And there are some cases where you may need to pay some income tax on that interest. Okay. So interest is usually expressed as a percentage, and it is definitely the money that the financial institution will pay you for keeping the money deposited with them. And compounding, the definition is earning interest on the interest. Okay. So the whole idea what you want to think about here is, depending on how the interest is compounded, whether it's daily, monthly, or annually, it makes a difference in how much money you earn. The more frequent the compounding, the more interest you earn. So let's make sure that you understand that. It's going to take the amount of money plus how long you keep that money in the account that you're keeping, okay? And how frequently the compounding is taking place, that will determine how much money you have at the end of the year after while you're in your savings journey, right? By the end of your goal. So you definitely want to ask the question, how frequently is the interest compounding on the money that I wish to save at that particular account? Okay. Next, another piece or a term that you definitely want to consider in your savings journey is annual percentage yield, otherwise known as APY. APY reflects the amount of interest you will earn on a yearly basis, and it is often expressed annually as a percentage. This is different from an interest rate, okay? It includes the effect of compounding. So yes, the more often your money compounds, the higher the APY and the more interest you earn at the end of the year. Then you also want to look at the APY is the best way to compare your potential earnings from different accounts. So you want to do some research. You're not only looking at the interest rate in which you use to open your savings account, but you want to know what that APY, what that annual percentage yield will be at the end of the year. And that's going to be huge to determine where you will place your money, in which high yield savings account you will use, whether you use a money market or a CD or any of the other savings options we've discussed. Next, remember, so you've got to do the research, ladies and gentlemen. Consider the advantages and the disadvantages of savings options that are available to you. Some of them very accessible, some of them cost-friendly, some of them not. But whatever you do, you've got to look internally at your financial picture. What are your personal goals? Consider everything that is meaningful about your savings journey, and just consider and weigh the pros and cons before you decide where you'd like to place those dollars. Those are your hard-earned dollars, and you want it to go somewhere where it's going to make you money over time. Next, the purpose and the importance of savings is very, very, very clear to some and unclear to others. And the bottom line for me, when I learned how to start savings, it was because there are unexpected expenses that always pop up. If you keep living, I trust you, there will be unexpected expenses. And we're going to talk about what those unexpected expenses look like next. The key takeaway here is an emergency savings fund is part of the foundation of anyone's financial health. We're starting off small. Setting aside $500 to $1,000 can cover many unexpected expenses. That could mean the difference between, again, paying for a patch on a tire to replacing an entire tire, That could mean perhaps a covering expenses at a pharmacy or a doctor's office visit. It could mean paying for the groceries that you just simply needed at that very moment. Perhaps your wallet was stolen, but the only thing you have is the money and cash in your pocket, or the money that you have access to at your bank account or your banking institution. Trust me, having dollars set aside for those emergencies can mean a lot to someone who just doesn't seem to have access to credit, or if they don't have access to an ATM. Next. So why save for unexpected expenses? As I mentioned, life happens, and because unexpected events occur. Again, if you're setting aside money, separating it from the money that you would normally use to pay your rent, your utilities, your transportation, those savings can really step in to pay for those unexpected expenses. A water heater has blown up. Travel to a funeral, perhaps maybe even emergency dental work. Whatever those things are, make sure you have dollars set aside for those kinds of expenses. Next. Emergency savings fund goal. Well, here's the truth. We started off as a beginner at saving 500 or maybe up to 1,000. Well, the truth is, in today's market, in today's economy, the wise thing to do, and what you've probably heard many say, is that you want to establish an emergency savings fund from 3 to 6 months of expenses. And how do you determine that? You write down every single expense that you are making for that month, including your rent, your utilities, groceries, transportation, insurance, maybe your dining out money, all of those cell phone bills, utility bills, all of that. Write it down, total those expenses, and then multiply that by 3 and by 6. Whatever the total amount is, that is what your savings, your emergency savings goal should reflect. If you have $5,000 in expenses, times that by 3, your emergency fund should be $15,000. If you are saving up to 6 months, then that total emergency fund should be at $30,000. I cannot tell you how during COVID season, in those 2 years, having my emergency savings fund in for those 3-4 month savings really did help to manage my expenses and life and sustain me during that season. Now, it's not going to be easy. It's going to take time. It's going to take commitment. It's going to take some discipline. And I promise you that practicing a mindset and a behavior of savings is going to become much more easy over time. And it's going to be automatic. It's going to be a cycle. Once you take something out, you're automatically going to want to replenish it. And no matter what happens in your life, no matter what expense you are paying, it is still worth doing. It's still worth saving. And it's an important step to improve financial health and stability. No matter how small the amount is, no matter how you think insignificant it is, trust me when I tell you, saving money and putting it aside is going to mean the difference for a lot of families out there listening to me today. It's going to mean the difference between not having it or utilizing it, placing all of that debt onto credit cards that you may or may not be able to pay for at the end. So make sure you use discretion, use your mindset, use your wisdom and gut instinct when it comes to saving money. Next, the number one component to having a savings account is to accommodate those opportunities when there are changes to your income. They are going to change. There are some bills that come once or twice a year that you're just going to need to pay, that you don't necessarily pay monthly and you forget, oh no, I've got to pay that car registration bill. I didn't anticipate it. But you have money set aside for those occasions. And then also your spending can increase temporarily. There are certainly 2 months of the year in my personal finances when I know expenses are higher than in the other months of the year, January and June. And having a savings account set aside for those unexpected expenses will accommodate those unexpected bills that come, i.e., a life insurance premium or car registration and even car maintenance. I usually maintain my car in June with a tune-up, all of that. And so I know that in June, I'm going to take my car, and that's an additional $750 to $1,000 that I'm making sure my car is healthy and can take care of me for the rest of the year. Okay. So definitely you want to make sure that's available to you with a savings account. Next. So the key takeaway, if you are saving now for the first time, set that goal for yourself. Set that goal that by the end of this time next year, you will save anywhere from $500 to $1,000. And see if that's something that you could rationally, reasonably, realistically save for. And see whether or not, and you can determine for yourself at the end of this, reaching this savings goal, whether or not you have been able to benefit greatly from having this money set aside, because it certainly can cover many unexpected expenses. Okay, this is my time. This is everything I've told you about the advantages of saving a goal, why you want to save your money. But now you're going to now listen to my colleague, Lisa Hill, who's now going to talk about saving for your goals and then how LA Saves is going to help you meet that challenge. Take it away, Lisa.
Yeah. Thank you so much for all the information that you provided. We want to discuss how to save money to reach your goals and to prepare for those large expenses. Next. The key takeaway for this section is to create a plan to save money for your goals. Next. We've taken the first step towards setting goals by thinking about what you want from your life. Now you'll learn how to turn these ideas into written goals and that are clear, realistic, and achievable. Next. So what is a goal? A goal is a statement about a result you want to achieve. The most powerful goals are SMART goals. So we can see here that SMART goals start with you asking questions about specific, what exactly do I want to accomplish? Measurable, how many and how much? It also has to be action-oriented. What specific action do I need to take the achievement to this goal? And it needs to be reachable, meaning, can I realistically achieve that goal? And then also time bound, which is, can I reach this goal? Does it have a deadline? Next. You're more likely to achieve your goal, even SMART goals, when you write them down, you post them where you can see them every day, like on your bathroom mirror, you can post it in your car, You can post it on your refrigerator, so that way you can see all of the goals that you want to achieve. You can also share them with others for accountability. And then only focus on one or a few goals. If you focus on all of them, it could be overwhelming, but take them one step at a time. Next. Why is it important that we write these SMART goals down? It's because they're very powerful when you write them down, especially when you are involving your money. So many goals require savings, and the only way to achieve this is by having enough money set aside. So what does enough mean? The amount of money you need to save depends on what you're saving for, how much it will cost, how much you still need to save if you have some savings already, and when do you want to reach your goal? That's important. For example, like Linda had said about building your emergency fund, you want to look at $1,000. So we can take $1,000 over 2 years and just say we haven't even started savings, but we want to start the $1,000 savings now. So you can look at breaking down your goals into smaller steps. You could do it on a daily, weekly, monthly, yearly basis. So let's take a weekly example. So we have $1,000. There's really 52 weeks in a year, but we're going to use 50 weeks. So divide that, take 50 times 2 years. That gives you 100 weeks. And then take the 1,000 divided by 100 weeks, which equals $10 per week. So with that in mind, we're going to save $10 per week over the next 2 years. So the result of that is $1,040, which exceeds even more than what your goal that you had started out with. And that doesn't even include interest. Next. Here's where we will learn how to plan for larger expenses, because many goals are related to those large expenses, such as a car, it could be a refrigerator, appliances in your home, any of that effect. And then also unexpected emergency is a large expense as well. So it's a way of, it doesn't even cover the 1 or 2 paychecks that you get. So you got to pre-plan for these large expenses. So we can start by saving for these large expenses in advance by the weekly, daily, monthly, yearly, putting away aside funds. Or we can also look at, if you're looking at a car, for instance, you want to do some comparison shopping, especially for the best price or value of that item. And then once you have that, you could take the money that you saved as part of the down payment, and what there was remaining that you weren't able to cover, you can actually borrow it if necessary. Next. So remember, the key takeaway from this section is to create a plan to save money for your goals. Next. Here's where we come into LA Saves is part of America Saves campaign. It's a national effort to help individuals build financial stability. We encourage you to start small, think big with America Saves. To get started, you have 3 simple steps. You need to set a goal, make a plan, take action by visiting lasaves.org. Next. PNC Bank's annual financial wellness in the workplace reports that 67% of the workers now say they live paycheck to paycheck, up from 63% in 2025. Did you also know that 86% of people worry about their financial plan? And 46% say personal financials affect their workplace productivity. 71% of people report it impacts their mental health, and 54% reported that it impacts their physical health due to financial stress. So we would like you to take the first step. Now is a great time to take the LA Saves Pledge and start building and saving to improve financial stability and overall well-being. Next. The 2023 FDIC National Service of Unbanked or Underbanked Households found that 4.2% of U.S. households, representing 5.6 million households, did not have a bank or credit union account. Did you know that by opening a bank account, one of the most important steps would be taking in reaching your financial goals? The benefits of a FDIC insured bank account, as Linda had said, it provides financial safety for your money. It offers easy and secure access to your funds. It protects your deposit at an FDIC insured bank. And how to get started. You can open up a bank account at FDIC insured bank by visiting fdic.gov/getbanked. Here's another opportunity. Next slide. Here's another opportunity that you can also participate is Bank On Los Angeles County has over many large local banks that offer safe, affordable banking options, which include low to no monthly maintenance fee, checking or savings account with a minimum opening balance of $0 to $50. And then also no check cashing fees. And then you can also have online billing payment options for free. Next. How money smart are you? Next. You can go to playmoneysmart.fdic.gov to learn more about everyday financial topics. Next, take action. Now is the time to turn your goals into action. Choose one financial goal to focus on, write it down, and make it SMART. Decide how much to save and how often. Start small and save consistently. Use available tools and resources for support. Again, take the LA Saves Pledge and begin building your savings today at lasaves.org. Next. Thank you for your participation. Any questions?
Let's get to the questions. Let's see. Thank you, guys. Well, okay. Let's see. So someone has, there's a few questions that have come in about examples. Can you give me an example of some of the tips about how to find the best high-yield bank accounts? And
yes,
like the CDs and things like that.
Oh,
are there
okay.
any examples? Yes.
Yeah. There's a couple of tips, and I think I'm thinking of one is my mom is a big saver, and she likes to go online every day. Actually, she Googles the institutions and stuff, and she'll find the best yield savings to actually transfer her funds into. So you could do that, going to each bank. Also, I thought a friend of mine had told me about if you have a Fidelity Federal account. And I know that with that, they offer where you can see all banks listed with interest rates and how much you need to put in the account and stuff. And I thought that was a neat tool. So that is a way to do it as well. And then also just going to your regular, if you have your own bank account, maybe asking to see the wealth manager at the bank when you go in and find out what their interest rates are during the time that you're making a deposit or withdrawal in your own account.
You know, there are also, thanks, Lisa. You know, there are also a few credit card companies that offer also high yield savings accounts. I'm thinking right off the bat, Discover is another great vendor for HYSAs. Citibank is another one. So if you are a card holder with a bank, check to see whether or not they offer high yield savings account options. PayPal is another one that offers high yield savings accounts. So you definitely want to make sure, do some comparison shopping, who offers the greatest interest rate on your money, and start setting up your direct deposits or transferring money over to those accounts.
Thank you both. A few other questions. Okay, do you have, let's see, so for the IRS and taxation, do you have, talk about taxation of a bank account interest? Do you know how much IRS takes from the earned interest? Is that?
Oh, yeah. That's a great, that's a great question. Yes. Depending, for example, did you know that as a homeowner, you could write off the interest on your mortgage every year, which is a wonderful thing that I learned. And as a matter of fact, here's the tip, ladies and gentlemen. If you own a home, which is a great reason to save, start saving now for that home. For the first 13 to 15, 16 years of your mortgage, the bulk of the dollars that you're paying toward your mortgage is strictly interest. And you could write off that interest in your tax returns. So that's because for the most part, banks are lending you this money for their mortgage, right? And they want to get as much money back for the fact that you borrowed for them, right? So for the first 13, 15, 16 years of your living in your home, you're paying interest. The mortgage you're paying is not even hitting the principal. But you could write off that interest on your account. You also want to be mindful of any other accounts. For example, if you have investments or an inheritance, there's something called capital gains account,
I know
right?
about that.
Yeah, those are taxes. So you want to be sure to read the fine print. Don't just listen to what the folks are telling you. Read the fine print. So make sure that any taxes that are attached to your name, make sure that any dollars you take out of your 401k, any loans you take out of any of your, that is income. And if there's an opportunity for those vendors to make money off of your money, you've got avoid it as all cost. But definitely, you got to read the fine print and talk about that. That's why your banking relationship is so important. Talking to your bankers, ask them those questions. They know how to answer them. So please, I'm glad. That's a great question.
Yeah, I wanted to add to yours, Linda, because of us being out there doing VITA, working on the taxes for other people and stuff. But in 2025, they actually opened it up where you can actually now write off, if you're buying a car, you can write off the interest of the car.
There you go.
So that's one thing. And then the other thing is that student loans, you can actually write off the interest on student loans up to $2,500.
There you
Dollars. And then also with owning a home, you can actually write off your property taxes as well. So they used to limit it to $10,000, but now they opened it up to $40,000.
Yeah.
So you can write off up to $40,000 in your tax, your property taxes. So these are good taxation rules that came out.
And thank you, Lisa, because here's the reason why many Americans are going to H&R Block. They're going to SoFi. They're going to all of those get quick tax refund places. These are folks, you're doing your taxes online, and they probably are not sitting in front of you having these kinds of conversations, right? So you're just relying on online software to handle your tax returns. Please, ladies and gentlemen, this is no slant on anybody. This is not, again, remember, I'm not trying to represent anyone over another, but Americans, please, if you are filing your taxes, that is one of the most personal, intimate type of relationships that you are having at that time of the year. Only those who are savvy about tax law and what can be written off and what have you are going to ask you those kinds of questions. And so you want to be sure to have all of your documentation. You want to be sure you have all of your receipts so that people who are doing your taxes, i.e. an independent contractor like a CPA or a tax preparer or VITA, they will ask you those questions. And you will get the best result of your savings and also of your questions about interest.
Yeah.
Thank you. We have time for just one more question.
Yeah.
Please explain if a CD pays interest monthly or when it matures.
It really does depend on the CD that you purchase. So there are some, I know that in my banking institution, it is done monthly, and then there's also quarterly. I know that the CD that my dad bought for me when I was 12 years old on that particular thing, I mean, he literally had every 3 to 5 years, he was renewing the CD. And so by the time I got 18, but it's a fixed rate. So if you buy the CD at 5% or 6%, that's 6% compounding. Not only monthly, but annually. He looked at the APY. He looked at the yield of it. So that $10,000 at 10 years old or 12 years old when he bought it was double that by the time we got to 18. And that was a blessing for me in college. That and my grandmother's $5 birthday card.
It always helps. Yeah. Okay, we're out of time for now. Thank you both for a great presentation. And I wanted to let everyone know if anyone missed any part of this presentation, it will be available for viewing on LAPL's YouTube channel, youtube.com/Los Angeles Library. It's going to be available shortly. I'll also let everyone know there's going to be one more Financial Literacy Day event coming up. It's this Saturday, April 25th at the Bahamas Rancho Park Branch Library. So during that event, you can make an appointment for free private consultations with certified financial planners. And for more information on all of our Financial Literacy Month events, including making an appointment for Financial Literacy Day, our website is there, lapl.org/Financial Literacy Month. Thank you again, everyone, and have a great day. Thank you so much.
Bye.
Take care. Bye-bye.